In this video, I'm going to explain the benefits of private lending, and I'm going to give you an example of how a hard money loan works. Hello friends, I'm Jimmy Frank Rogers with LearnPrivateLending.com, where we help you maximize the return on your money as safely as possible by making loans on real estate. If you're new here, I'd love for you to hit the subscribe button below, and as always, the links to everything I discuss will be available in the description down below. So you may be wondering, what exactly is private lending? Private lending is simply where you are loaning out your money and acting as a bank for somebody else. It's very much associated with hard money lending. A hard money loan is a loan that is backed by a hard asset. So for instance, real estate. Perfect example is someone who wants to purchase a property, fix it up, and then retail out of it. A lot of times that person may not have credit good enough or assets good enough to be able to go down to their local bank and get a construction loan to do that. And so what they do is they approach someone like myself, a private lender or a hard money lender, where the main reason we're saying yes or no to the deal is based on how good the deal is. We're looking at the hard asset and we're asking ourselves the question, if for some reason the borrower is unable to pay us, are we okay with taking over that hard asset? How I first got into hard money lending or private lending is I was very much like probably you out there. I'm someone who was very much interested in real estate. I thought about becoming a real estate investor. Actually, what I wanted to become was a wholesaler. A wholesaler is someone who goes out and finds a deal, gets a house or a property under contract, and then actually sells that contract to some other investor who wants to do the work. So you're kind of getting the maximum profit with the least amount of effort. You're not actually having to swing hammers and supervise a job and see it through to completion. What I thought was that it was going to be a very, very easy process, something that I would only have to spend a few hours a week doing. Most of y'all know the reality is much different than that, and it actually took a lot more time. And in that process, I met another flipper, someone who was actually seeing the projects through, purchasing a property and getting it fixed up to sell, who was very experienced, had done quite a few of them. And it was kind of humbling just seeing their processes, how much time and energy went to it, how much money they spent doing it. It made me feel terrible. I was like, there's just no way I'm ever going to get to their level. But what was unique about my situation is my wife and I have always been very disciplined savers over time. And the flipper asked us, would you be willing to loan me money on a deal? And I thought, well, I don't know. I've never actually even thought about how that works. We looked into it, we did our homework, and decided to do it. And that was about 2.5 years ago. We haven't looked back since. It's been a wonderful experience ever since then. The benefits of being a hard money lender are a few of them. Number one, you're earning a very good return on your money, especially when you look at other comparative investments that you can do. I personally like to always compare any type of investment back to the stock market or buying a mutual fund. To me, it's reasonable to expect some kind of 7, 8, 9% return on your money with pretty much no effort at all. You can just invest, buy the mutual fund, hold it for 5+ years and sell it when you're done. Whenever I was looking at private lending, I think it's very reasonable to expect somewhere in the 12+% range on your money, maybe even more. The other benefit is you are helping out your community. You're taking a property that is not a good property. There's something wrong with it. It's probably in disrepair. You are helping get that property brought back into good condition, a really nice home that a family wants to live in. And that's a family that's going to start paying property taxes. That's a family that's going to be spending their money in the community. It's a good thing. The other part of it is you're helping another business person, someone who's trying to grow their career, grow their business, possibly hire more people. So by you loaning money, you're helping make that financial transaction actually happen. So it's actually a benefit to everybody involved. The only thing that we obviously have to take into account is managing the risk of the transaction and making sure that we're always asking ourselves the question that if the worst happens and the borrower is unable to pay us, are we okay with taking over the deal? So that's a little bit of how I got started in private lending and a little bit of the reasons or benefits of being a hard money lender and what that does for the community. So what I'd like to do next is I'd like to take you through an example of a hard money loan. I'd like to show you some of the different parts of it, show you how the math works and what it looks like. Also, I'd like for you to stick around to the end. I've got a special bonus for you that I think you're going to enjoy. So what I'd like to do now is show you an example of a hard money loan. What I'm using is my deal analysis calculator. This is an Excel spreadsheet that I built to personally use whenever I'm making a decision on whether to fund a loan or not. It allows me to put in all the variables and quickly do the math to see if it's something that makes sense to me or not. So let's start with the very beginning of it. Anything in yellow is the variables. So first part is the purchase price. This is the amount that the borrower is paying for the property. So for argument's sake, let's say it's $50,000. The next is the rehab estimate. This is how much the borrower believes it's going to cost to get the property into retail ready condition. We also want to make sure they're including any holding costs. So that might be an example of if they had to pay the property taxes, or if they had electric bills or water bills, anything like that that might have to be paid during the time that they own the property. So let's say, for example, that's going to be $20,000. Next, it's going to give us the total of the rehab plus the purchase. This is automatically calculated, so $50,000 plus $20,000 is $70,000. We haven't included a loan amount yet. The next thing we're going to enter in is how long do we think it's going to take the borrower from the time that they actually close on purchasing the property to the time that they close when they sell the property. Generally speaking, a borrower is going to be able to do that somewhere between 90 and 120 days. If it's anything longer than that, that's not something's going wrong. So for our example, let's say it's going to take 3 months, 90 days. The next variable that we want to input is the estimated ARV. This is what we call the after repair value. How much is this property going to sell for once everything is done? Generally speaking, a flipper needs to have the rehab and purchase amount be 70% or less than whatever the actual amount it's going to sell for. So for this example, let's say they're going to sell for $100,000, just to keep the math real simple. So $70,000 is 70% of the ARV. Next, we'll input what we think the closing costs will be. This is what the borrower is going to have to pay. So whenever you go to closing, there's always a certain amount. They call them settlement fees. The property taxes will have to be paid. They'll be prorated. Any closing fees, title fees, insurance, things like that. So let's say here in Texas, a good example is about $1,500, $1,500. Now we're going to input the terms that we are going to ask the borrower to accede to. So percentage of the total cost funded. For this example, let's say we're going to fund 100% of the purchase and rehab amount. So that's $70,000. We're going to do 100% of that, so that means our loan amount is going to be $70,000. See, it automatically populates over here under loan amount. Now we are going to charge some origination points. A point is 1% of whatever the loan amount is. This is money that we charge up front at closing whenever we first fund the loan, because it allows us to lower our risk on the property if something happens right off the bat where for whatever reason the borrower is not able to pay us. So for this example, let's just plug in 4 points. 4% of $70,000 is $2,800. We're going to charge an interest rate. Let's say we're going to charge, for simplicity's sake, let's say 12%. This is the annual percentage rate or interest rate. So 12% of $70,000 over 3 months is going to be $2,100. 1% per month. I don't know if you saw how I did that. $70,000 divided by 1% is $700 per month that they're going to pay us, times 3 months that they own the property. So 700 times 3 is $2,100. We're also going to charge some loan fees up front. This is going to cover our costs for servicing the loan, making all of the rehab draws that we have to pay the borrower whenever they finally complete work. Let's just, for simplicity's sake, say that's $1,000. So what this calculates over the entire term of the loan, the total amount of hard money that this borrower is going to pay us $5,900. If you look and see how much the borrower needs to be able to bring to the closing, the first closing, whenever they're purchasing the property, it's going to be $5,300. Where that comes from is they're going to need to bring the points, the 4 points, the $2,800 plus the loan fees of $1,000, so that's $3,800, plus the closing costs, because they're responsible for the closing costs, gives us a total of $5,300. So if we look at the total analysis of how much is this costing the borrower, how much money is the lender, the lender, making on this deal. If they sell the property for $100,000, the borrower is making about $22,600, or 79.3% of the profit. The lender, ourselves, we're making $5,900, or 20% of the profit. If you look at our ROI, or our return on investment, it equals about 8.43%. So that's $5,900 divided by 70,000. We made 8.43. If you were to annualize that, assuming in a perfect world, we could do this loan 4 times in a 1-year span, because the loan's only taken 3 months from the time we purchased to close. And if we were able to do a loan on January 1st and on March 31st close, and then on April 1st do another loan, and so on and so forth, you could do 4 loans, you'd be making 33.71% on our money. It's been my experience that generally if you can turn your money 2 times in a calendar year, that's pretty good. Sometimes you can do a little bit more than that, but that's what I shoot for. I'd like to turn my money at least twice. So in that scenario, I'm going to be making about 17% on my money. So I promised you a bonus. What I'd like to be able to offer you is a free gift. If you'll go to my website, learnprivatelending.com, and subscribe to my email list, free of charge, I'm going to send you a copy of my Excel sheet that I use. I call it my deal analysis calculator, that I personally use on each and every one of my loans. So again, go to learnprivatelending.com, subscribe to my email list, and I'll send you my deal analysis calculator absolutely free. Thank you for taking the time to watch this video. If you got some value out of what I discussed, please subscribe. Also, leave a comment down below about what you liked or what topics you might like to see me cover in future videos. Hope you have a great day.